2021 was a great year for residential real estate. It was the perfect storm as far as incentives to buy a house. Rock bottom, low interest rates, a lot of ready inventory for people to choose from, and a pandemic-fueled need for your own space and a bigger space. And we're seeing it in the numbers that have come out from last year. So according to ANAROC, for example, housing sales rose 71% in 2021. Knight Frank says residential sales grew by 51% year on year. This is, of course, in the top 7-8 cities. The question now is, what happens with Omicron? Does that same need to continue buying a house now is something we will see sustaining in this new year? Is residential real estate going to continue its hot streak? And where will you see the best picks? Are we also going to see the same kind of prices, considering input costs have gone up for the sector as well? To speak on some of these issues, I'm joined now by Prashant Thakur, Senior Director and Head Research at ANAROC Group, and Ghulam Zia, Executive Director at Knight Frank, also joins us on the show. Welcome to both of you, and thank you so much for speaking with us this evening. Mr. Zia, let me begin with your overview of 2021. And was that an outlier year for the industry, or do you see that upswing continuing?
Well, I think you have packed in all the questions that we would have discussed today in one. Let me try to do justice to what you have asked. To start with, yes, 2021 was definitely an outlier. More so of an outlier because almost after 7-8 years of depression in housing market have we come across this year where everything seems to have turned around completely. About 6 to 7 years when economy was doing fabulously well, there was job creation, wealth creation and so on and so forth. But housing sales were just not picking up. So a lot of these efforts, whether from government agencies and banking sectors, etc., have really not been able to enthuse the buyers as much to come out and start buying. Perhaps that's exactly what, as you're talking about, the silver lining. Like when we are cursing the pandemic, at least real estate has to really look up to it, because pandemic was the one which really kicked the whole momentum, started all over again. So 2021 was all about that. The second wave brought the buyers back into the home market and the transactions started shooting up. In fact, as our numbers suggest that this kind of transaction numbers you're looking at in many markets haven't happened in last 10 years. So that is exactly, to sum it up, 2021 was a fabulous year for the real estate, especially home markets. And the way things are looking up, I don't believe that the party shall stop so soon.
Well, the question is that are there enough party goers still there? Mr. Thakur, let me take that question to you. Those who felt the need for a bigger home and who shopped around perhaps have satiated that requirement. Do you think there's still many more out there? The demand still persists and we will see that. Are you not fearing any impact of the Omicron wave which we're currently seeing?
So, Tamanna, first of all, a very happy New Year to you and your viewers. And before I answer your question, let us just look back how 2021 was different from other years in terms of real estate cycle. So, if we look at both the parties, be it buyers or developers, I think there was a lot of maturity that came into this industry. 2021 was primarily driven by end users. Unlike investors in the earlier uptick that we saw. The second remarkable point to note was that the developers showed a lot of maturity this time. If you remember, post-global financial crisis, when we saw a pullback in the residential real estate sector, the developers were quick to kind of jack up the price, quite steeply, and that kind of led to a huge amount of unsold inventory and then the buyers retreating. Whereas if you look at 2021, the developers showed a lot of maturity in terms of pricing. They kind of, did not increase the price randomly, though, there was a huge pressure in terms of input cost. While we saw some kind of increase in ready-to-move-in inventory. The regulatory environment was also quite supportive. RERA and I think other state agencies kind of showed a lot of resilience in terms of timely intervention. And if you look at the ticket size that has been driving, it is more of budget and affordable segment. Now coming back to your question that will the party still continue? So during this pandemic, everybody realized the importance of physical asset, and that's where a lot of fence sitters who were waiting for price to correct, interest rate to go further down, started to buy. And if we look at how the whole ecosystem has evolved, I think the digital adoption by the developers, or let's say the buyers also, this ecosystem, if had this pandemic not been forced upon us, I would call it a blessing in disguise. We would have been, adopting to this digital journey. It would have taken more than 20 years. We covered that thing entirely in 1 year. So the sector is more resilient. The buyers are there, and the pricing is still very competitive. Interest rate, though it is expected to move upwards from the second half, I think will be still quite affordable. And if you look at a few of the policy intervention the state governments are announcing, for example, Maharashtra is thinking of extending the 50% premium discount on the other approvals, and they have also recently announced that there would be waiver of registration tax if the property is below 500. So I think these are a precursor for the things to come. And if we look at the kind of pullback we saw after the second wave, which was really very deadly, and while people are saying that Omicron will not be that fatal, and thanks to the rapid vaccination we have, I think the party will still continue, and because the market is more robust now. If you look at the developers' balance sheet, they have also kind of been able to shed a lot of debt. If I talk about the listed space, they have brought down their debt by 37%. So I think the ground is set for a robust growth. I would put a caveat that the pricing discipline has to be there. We need to see where the equilibrium lies. But yes, I think at least first half we'll see the growth story continuing.
Another big trend that we saw last year, and we should see if that continues as well, is that it was a great year for branded big developers, and a lot of smaller developers fell by the wayside and could not withstand the gale force of the pandemic. Ghulam Zia, do you see that trend consolidating?
Well, last year or last 2-3 years, the trend that you spoke about was pretty visible and noticeable. But then let's face the resource constraint that even these quality players or the listed or the A-graders have to face. While you would want them to pick up pretty much the whole real estate industry, but then that is not going to be true. You will need a lot more developers than what you just spoke about, the A-graders, etc. And we have seen this every time the cycles turn. You do have new players coming into the market, and that is something which is expected all over again. So it is not possible that the whole space will be occupied only by the A-graders. You will have to have the mid to lower end of the players as well in the market, and that is something which we'll expect to happen in times to come. So while in last couple of years, many of these projects have been cornered by the A-listers, the top developers, a lot of these projects are still stuck up. I'm sure this is one of the subjects we need to really talk about, that not everything is so rosy about it. There have been a lot of stuck projects which have been supported by even the government initiatives like Swami, etc. So there is a lot of work to be done in that side of market where things are not really so good. The listed developers have already picked up the good projects where there was enough of juice to be extracted out of it. The others are still out there, and we need to find some solution. I'm sure new fresh faces, new developers will come up in next times to come.
Yeah. The other perspective that we have to understand is what are the prices going to be like. I talked about in the opening comments of this show the perfect storm that contributed to a lot of people sitting on the fence to wanting to buy a home. So whether it's good prices, low interest rates, and a need that arose because of the pandemic, all those factors were there. Mr. Thakur, do you think that the good pricing will continue? We've already seen prices inching up, and a lot of developers put it down to increasing input costs. Steel prices, cement prices, etc. have gone up. Do you see that being a hindrance to buyers?
See, as I said earlier, that the pricing has to go up. But to what extent, that is kind of debatable. But again, having said that, this is clearly a buyer's market, and developers will have to understand that they cannot increase the price to an extent where the affordability becomes questionable, because this whole growth that we have seen in 2021 is based on the hypothesis of very, very good affordability. Now, in my opinion, taking into account the supply chain disruption that we have faced, the rise in input cost, I expect a price increase of 5 to 8%, because we also need to understand that few things are also acting in the favor of these new launches. With the land prices, reaching kind of equilibrium, with huge amount of influx of land coming in, and then a lot of projects are being launched in the peripheries, where the lands are quite competitive as compared to the city centers. So this would keep the price and the ticket size of the unit under check. So I think 5 to 8% is the limit where the buyers can absorb, because they also do understand that the prices have gone up. And if you look at other industries where automobile and other the consumer durables, they are willing to pay the extra price because they understand now. The customers have also kind of evolved. But anything beyond that, I think would bring this affordability question under question mark, and then we can see some kind of disturbance happening. So that's the point I wanted to highlight. The price increase is required for survival, but it has to be in certain range bound.
Ghulam, you want to come in on the price point? Will it be as affordable this year as well for those still looking to buy?
Well, since we're talking affordability, we have our own affordability index on which we measure how much of the current prices are burdening the pockets of a buyer. So this is the share of the salaries or monthly earnings that you would put aside as EMI. And that number has drastically changed in last almost about 9 to 10 years. Mumbai used to be 97 to 98% of the money that a buyer had to pay for the EMIs. That has come down to somewhere close to 50, which is very, very affordable. Ideally, it still has to be about 40%. And except for Mumbai, all other cities are in that affordable range of below 40%. In fact, a few of these cities like Ahmedabad and Hyderabad, etc., are 27 to 28%, which is very, very affordable. So the point then is, when the things start turning around, how much of a burden the buyer is willing to take. As Mr. Thakur was also talking about, we will have to wait and watch, because ultimately it's economics is all about price discovery mechanism, and we will see that happening in times to come. But the moment it breaches the affordability limit, once again, the fear of the market retracting, the fear of the buyers not very keen to buy can turn around. However, globally we have seen that the prices of real estate have also will have to be in tandem with the prices overall. The input costs or even inflationary trends are to be taken care of. So about 50 to 100 bips over inflation is what I would normally peg the expectation of price rise. If it is not happening that way, purely because last so many years the prices have gone completely berserk. So while it has corrected in last 7 to 8 years, here on, if I have to look at any price recovery, it will have to be linked to inflation, nothing more than that.
One more question, and let me come to you first on this, Ghulam. Is the investor coming back, or is the market still for the end-use buyer?
Well, I would still say it is not, first of all, good for an investor to take a punt right now. Because if we are yet looking at 4 to 5% kind of annual growth of prices, that is way lesser than the other alternatives are available for a buyer to look at. And real estate, with so much of a liquidity concern, selling an apartment is not as easy as selling your shares on the stock market. All that taken into consideration, ideally, I would not buy an apartment if I'm not expecting the prices to double up in next 5 years, for which we require at least 12-13% kind of annual increase that has to happen in prices. If it is not happening, then obviously this is not investors' market. And that is reflecting, as Mr. Thakur also pointed out earlier, that the buyers today are genuinely end users. We still don't see investor pumping in. Investors are not very keen because the kind of returns that the real estate is showing for next 2-3 years is not very, very healthy from investment perspective. End users are always welcome, best market to buy.
All right. So it is still a market for end users. Let's see if real estate continues. It's a great story in 2022, or does Omicron shake the boat? Thank you so much, Prashant Thakur and Gulam Zia, for joining us today.
Thank you.